Good day, everyone, and welcome to the Blucora First Quarter 2014 Earnings Results Conference Call. This call is being recorded. With us today from the company is the President and Chief Executive Officer, Bill Ruckelshaus, Chief Financial Officer, Eric Emmons, and the Senior Director of Investor Relations, Stacey Ibarra. At this time, I would like to turn the call over to Stacey Ibarra. Please go ahead, ma'am.
Good afternoon, and welcome to Blucora's investor conference call to discuss first quarter earnings. Before we begin, I'd like to remind you that during the course of this call, Blucora representatives will make forward-looking statements, including but not limited to statements regarding Blucora's expectations about its products and services, outlook for the future of our business and growth initiatives, and anticipated financial performance for the second quarter and future periods. Other statements that refer to our beliefs, plans, expectations, or intentions, which may be made in response to questions, are also forward-looking statements for purposes of the safe harbor provided by the Private Securities Litigation Reform Act. Because these statements pertain to future events, they are subject to various risks and uncertainties, and actual results could differ materially from our current expectations and beliefs. Factors that could cause or contribute to such differences include, but are not limited to, the risks and other factors discussed in Blucora's most recent quarterly report on Form 10-Q on file with the Securities and Exchange Commission. Blucora assumes no obligation to update any forward-looking statement, which speak only as of the date the statement is made. In addition, during the call, our management will discuss GAAP and non-GAAP financial measures. In the press release, which has been posted on our website and filed with the SEC on Form 8-K, we present GAAP and non-GAAP results, along with reconciliation tables and the reasons for our presentation of non-GAAP information. We have also provided supplemental financial information to our results in the Investor Relations section of our corporate website at blucora.com and filed with the SEC on Form 8-K. Now, I'll turn the call over to Bill. Following his comments, Eric will review first quarter results and second quarter outlook. Then we'll open up the call to your questions.
Thank you, Stacey. Happy to be here today. Blucora had a solid start to the year. Revenue was up 31% over first quarter last year, driven by growth at TaxAct and the addition of Monoprice, which we acquired in August of 2013. Our performance in the quarter underscores the profitability of our three businesses and the growing diversification of our company. Our strategy at Blucora involves operating and investing with discipline. If we execute consistently over the medium to long term and continue to meet the needs of customers in our markets, Blucora will be successful. Now for an update on our three businesses. TaxAct performed very well in a shortened tax season, and I want to especially thank the team at TaxAct for another solid year of execution, product innovation, and profitable growth. The IRS opened on January 31st, and like last year, filers started and completed their returns later in the season. We again saw record activity in the days leading up to April 15th. TaxAct generated more than 5.5 million consumer e-files this season, up roughly 5% over last year. Professional preparer filings were up 9% year-on-year to 1.3 million. Combined, TaxAct assisted approximately 6.9 million filers this tax season, up over 5% versus last year. Our share expanded in total filings and prep filings. Core consumer filings share fell slightly this season in the face of faster DIY market growth and aggressive competitor pricing. Our team stuck to its playbook. As in prior seasons, we focused on customer growth and increasing ARPU, while at the same time driving marketing efficiency and effectiveness. From a market perspective, we were pleased to see the DIY category gains overall and view the enlarged pool of filers as a future opportunity for TaxAct. Of course, we face competition from large players in tax prep whose strategies and tactics can differ meaningfully season to season. We monitor competitor actions in season and look for opportunities, but the team is remarkably effective at staying focused and leading from the front as the value leader in do-it-yourself. TaxAct expects 12% revenue and 19% segment income growth for the season. ARPU expanded nicely, aided by mix shifts and increased attach rate on new offerings. We demonstrated significant operating leverage through disciplined marketing and expense management. On the product front this season, we launched a number of new offerings, including a differentiated smartphone app for tax filing, TaxAct Express. We now offer tax filing solutions for PC, tablet, and smartphone users, all with anytime, anywhere access. We are proud TaxAct was recognized by PC Magazine this season as the editor choice for both Best Free Tax Preparation Service and Best Paid Tax Preparation Service. With great products, a better value proposition, and increased consumer awareness, TaxAct continues to be well positioned to grow in multiple areas. We are excited about our future opportunities together. Now turning to e-commerce. As expected, it was a challenging Q1 retail environment, but Monoprice performed in line with our expectations in the period. Monoprice continues its efforts to build awareness among technology consumers. In the first half of this year, the team is operating cautiously, monitoring consumer sentiment, marketing efficiencies, and site performance to continue to grow profitably in a soft market. Our long view of the Monoprice opportunity is unchanged. The value proposition is compelling and quite simple. Quality products at fair prices with excellent customer service. In Q1, we launched new products in our audio, computer accessories, and networking categories. We also launched a line of home automation products to great reception. New offerings, line extensions, and new categories are all critical to keeping Monoprice top of mind and exposing the brand to new shoppers and new purchase occasions. We will continue to be cautious in our guidance for Monoprice as we navigate in the first half of the year and make needed investments in site optimization, marketing systems, and data analytics to enhance decision-making and accelerate customer acquisition. We are strong believers in the multi-year growth potential with this business and the significant opportunity in strengthening the Monoprice brand. Turning now to search. Q1 performance was slightly below expectations this quarter, driven by slowed growth in both our owned and operated properties and in our distribution network. Our search business is going through a number of transitions that together are creating headwinds for us in the second quarter. I want to take a moment to highlight some of these transitions and what we are doing in response. First, in late February, we implemented a technology change with our search partners that ultimately will result in faster deployment of features and enhancements across our network. Unexpectedly, this technology change significantly impacted marketing efforts to our webcrawler.com property, which resides on a separate code base. In response, we significantly reduced marketing spend at WebCrawler to maintain desired rates of return, resulting in decreased revenue. We are currently implementing changes to our tech solution to offset these impacts, and while we expect a recovery, we cannot predict today when that will take place. Second, we are transitioning our business pursuant to our renewed Google partnership, which, as previously discussed in February, excludes Google mobile search going forward. These transitions coincide with our implementing the earlier referenced technology change across our distribution network. While impacts of the technology change to our distribution network are less pronounced, we believe the combination of these events is creating uncertainty with our partners. In the past, we have experienced disruption in our network when uncertainty or changes are introduced. It proves challenging to bring new partners aboard and challenging to grow existing partners as they test and adapt to changes. We believe our new partner additions will resume and performance of our existing partners will improve as we move into the back part of the year, and we are working to accelerate this transition. Key to this effort will be actively monitoring the quality of our network to make sure our partners continue to bring value to both users and advertisers. This is a constant focus for InfoSpace and becomes more important in times of transition and change. As a result of these factors, we are guiding search conservatively into the second quarter pending further visibility. While these dynamics affect our results in the short term, we believe the InfoSpace business will return to growth later this year. Our value proposition in the search marketplace remains centered on bringing quality traffic to our search engine partners and differentiated content and monetization solutions to users and partners. The team is experienced and now laser-focused on adapting to changes this year and navigating to a new baseline. In other news, last month we were thrilled to announce we have entered into a definitive agreement to acquire How Stuff Works, and we are excited to welcome their talented team to Blucora. How Stuff Works is a trusted digital information resource. Their growing audience generates approximately 200 million page views and 38 million unique visitors per month, with multi-format content that drives deep engagement across desktop, tablet, and mobile devices. We believe this transaction, combining How Stuff Works' high-quality content with InfoSpace's expertise in search, positions us to engage with end users across a broader array of touchpoints. The user journey online begins with navigation and often ends with an action. In between, there is discovery, idea generation, research and information, comparison, and decision support. We want to leverage search and content to provide value to users during their journeys. How Stuff Works represents an important step in this direction. In closing, we remain focused and excited about the plan in place to drive value at Blucora. We are taking decisive steps to address the issues impacting our business this year, and the long view for our company continues to be quite compelling. With that, I'll turn it over to Eric for more details on the financials.
Thanks, Bill. Let's start off with a review of our first quarter 2014 results, including segment performance detail, and then I'll close with consolidated outlook for the second quarter. Consolidated revenue for the first quarter was $216.2 million, up 31% versus prior year, and adjusted EBITDA was $56.9 million, up 24%. Non-GAAP net income was $50 million, or $1.12 per diluted share, and GAAP net income was $26 million, or 58 cents per diluted share. As a reminder, first quarter 2014 is benefited versus prior year due to the inclusion of Monoprice. We exited the first quarter with cash equivalents, and short-term investments of $336.4 million and net cash of $57.8 million. These totals reflect debt principal payments of $44 million made during the quarter. Turning to our first quarter segment performance, beginning with our tax preparation segment. Revenue for the quarter was $72.3 million, and segment income was $37.4 million, for a segment margin of 52%, which exceeded our first quarter expectations. First quarter revenue versus the comparable prior year was up 12% on DIY e-file growth of 5%. Now let's shift our focus to the first half expectations, which included the full tax season and provide a more representative view of the trends in the business. We are raising our first half expectations for our tax preparation segment to revenue of $97.5 million to $98.3 million. And we are also raising our segment margin expectations to approximately 55%. This translates to revenue growth of approximately 12% and segment income growth of 18 to 19% versus the first half 2013. First half expected revenue growth of 12% is primarily driven by consumer DIY reported tax season e-file growth of approximately 5% and ARPU gains of approximately 7%. The ARPU gains were primarily driven by paid software mix shifts coupled with increased sales of our add-on services. Our prepare software revenue, which represented approximately 10% of tax preparation segment revenue, is also expected to grow 12%. Segment income is expected to grow 18 to 19%, driven by our revenue growth and marketing efficiencies. Marketing expense for the first half of the year is expected to be up 2 to 3%. We are pleased with how the season has come together and believe the team executed very well in another competitive season. The financial results really do speak for themselves. With that, let's move on to e-commerce. Revenue for the quarter was $37.1 million and segment income was $0.5 million for a segment margin of approximately 9%. On a pro forma basis, revenue was up approximately 7%, while segment margin was down approximately 350 basis points, primarily driven by increased marketing expense. Orders were down 2% versus the prior year, which was offset by a 9% increase in average order value. As we had indicated in our last call, we were seeing slower revenue growth exiting the fourth quarter, which carried into the first quarter. While we attribute a portion of this slowing to macro-level factors and increased competition, we have also reviewed the trends within our business, and we are focused in a couple areas. First, we have seen a drop-off in purchase due to a mix shift in user acquisition toward paid channels. And second, we are seeing a decline in marketing efficiencies. We are focusing on these areas and actively pursuing initiatives to improve the trends. Looking forward, we are holding the mid to high single-digit year-on-year growth expectations into the second quarter. We expect segment margin to compress to the 7 to 8% range as we continue to make disciplined investments. Now turning to the search segment. Revenue for the quarter was $106.8 million and segment income was $19.2 million, up 6 and 5% respectively from the prior year. Revenue performance slightly missed our expectations, while segment margin came in at the high end of our expectations at 18%. The revenue miss was driven by slowing growth for both our owned and operated and distribution businesses. Owned and operated first quarter year-on-year revenue growth had slowed and was down 11% sequentially. Distribution was down 5% versus the first quarter 2013, and down 16% sequentially. Bill touched on the transitions driving the slowed growth in the first quarter that have continued into the second quarter. As such, let me spend some time on the second quarter expectations in light of these headwinds. We expect search revenue will be down year over year in the range of approximately 12 to 21%. We believe this represents the low point for the year. We expect segment margin will further compress in the range of 15.5% to 16%. This represents a step down in the expected second quarter search performance that formed the basis for our full year 2014 search expectations. To provide context as to the size of the step down, we expect owned and operated will drive just over a third of the revenue decline, driven by the impact of the technology change implemented on web crawler in late February. The remaining step down is driven by our distribution business and represents the combined impact of the multiple transitions Bill alluded to earlier. In light of these headwinds, our previously communicated full-year expectations are no longer achievable. That said, we are focused on getting back to sequential growth and expect to be in a better position to provide more clarity around the future growth expectations once we get through these transitions. One last thing before we leave search, please note that my second quarter expectations and full-year commentary excludes How Stuff Works, as the transaction is expected to close late in second quarter. Moving to unallocated corporate expenses, first quarter came in at $3.2 million, down sequentially from $3.5 million, and benefited from decreased headcount-related costs. Looking ahead, we expect costs to be closer to $4 million in the second quarter, returning to a more normalized level. With that, let's finish with our consolidated second quarter expectations. We expect consolidated revenue between $135 and $145.5 million, adjusted EBITDA between $26 and $29 million, non-GAAP net income of $20.3 to $23.2 million, or 46 to 53 cents per diluted share, and net income of $6.2 to $8.3 million, or 14 to 19 cents per diluted share. With that, let's turn the call over to the operator, and we will take your questions.